Thanks, Tom. Welcome everyone to the Fixed Income Funds Review. I'm Jeff Turnahoy. I'm going to cover a lot of the themes that Tom touched on earlier. Certainly we're both operating in the same economy, so the same factors that affected equity funds have affected the fixed income fund and the bond market as well. So here is kind of a style box breaking down the fixed income funds universe by their duration, short, intermediate, and long, and then they're by quality, high, medium, and low. We're looking at the universe of funds and through their surveyed data on their duration and their quality. So overall, when we look in the top right corner here in the red box, we see that those funds with a long duration and high quality, which is where we're going to find General US Treasury Funds, they suffered the worst performance on average. Looking down the lower left, those funds with a short to intermediate duration and a lower quality, indicating a risk on position, but not that convincing, since they are still going to use a short to intermediate duration product. Anyway, they outperformed. So we're going to find your loan participation funds in that group. Again, another theme we'll touch on later. The setbacks on treasuries and the ascendance of loan participation funds or senior loan funds. So the overall bond fund universe looked like this in terms of performance in each of the groups. For the short duration treasury and government products, we tended to see poor performance. I mean, not something that's going to cause you to lose too much sleep over in a quarter. TIPS funds were the worst performer in this group, down about 35 basis points. With Treasury, with inflation muted right now, it's not unforeseen that TIPS are going to struggle a little bit. Short to intermediate corporate funds, the investment grade group, they did show upside performance. Again, those low duration products with slightly lower, still investment grade qualities were going to be the stronger performers. Your general domestic taxable, this is your longer duration products. They're typically going to vary across the quality spectrum, but definitely the higher the credit quality, the lower they performed. You can see here Ginnie Mae funds, U.S. mortgage funds, kind of treading water near zero for the quarter, while above them high yield funds, loan par funds are 2% returns or better for the quarter. World income funds, as Tom touched on, the U.S. dollar was particularly strong in the quarter. These funds lost ground due to that. And then your municipal debt market, with the exception of high yield funds, returns were rather tight to zero or rather flat for the quarter. So we'll go into more detail now. We'll start off with Treasury performance. Treasury market remained range-bound. We saw the 10-year, which is that middle orange line, was kind of trending, getting just slightly above 2% on its yield, and then by end of February, beginning of March, some concerns emerged about Cyprus at that time, Italy as well, and we saw a little more activity, more money flowing towards the Treasury market. That seemed to be resolved by about mid-March before, again, Cyprus reared its ugly head, and we saw more Treasury buying as the quarter came to a close. So really it was mostly the last 2 weeks of March that did a good job of saving the quarter for Treasury funds. So in March, for example, we saw some decent performance out there. I guess I was thinking of the TIPS funds group. They actually gained about 17 basis points in March. Even U.S. Treasury funds, the General US Treasury group, is going to be that long duration, high quality group, managed to eke out about 9 basis points of positive returns. So March, a bit of a saving grace. I think that will continue to lead us into the second quarter for a little while. For reasons, again, that Tom pointed out, concerns remain about within Europe. The saber rattling between the Koreas is certainly keeping people on edge. and it's just enough to keep people interested in treasuries. The yield curve for these products remained pretty unchanged from not only the end of last quarter but the end of 2 years ago, so December 31st, 2011. Essentially the same yield curve. There's no change in this, looking over quarter to quarter, year after year. Not much movement there. Let's turn our attention now to the corporate bond fund side. High yield funds, AAA rated, A-rated funds. The lower the quality, the better the performance. There was a risk-on mentality right now. We've seen the high yield issuance slow down, which I think caused a lot of people to buy, who are taking on that risk-on trade, to bid up securities in this area because there simply was not enough inventory. So that was supportive of high yield funds. The rest of the market, the A and triple B rated, they had a tough time gaining traction this quarter. The next slide here shows what happened between the CC and poorer quality paper. That's the blue line up top, and then your AAA, triple B paper. When we start the year at 1, the triple C and lower market trended steadily upward, except for a pullback in near the end of February or end of March, beginning of February. And then accelerated after that. So they really did follow the equity market very closely, as we probably expect them to do. The other side, the triple B and the triple A, really did follow each other very closely in the quarter, with triple B managing a slight positive return and triple A down for the quarter. However, there are few corporate debt funds out there that invest exclusively in AAA paper. They're really going to look further down the quality spectrum. So we did not see too many funds ending the quarter with negative returns in the corporate debt area. Next group to take a look at is international income funds. This was the worst performer of the quarter among all mutual fund categories. Tom pointed out earlier exactly why this happened. The U.S. dollar took off like a rocket, particularly against the yen and the pound. Against the euro, it was up over 2% for the quarter. Overall, that is a headwind for international income funds. We also had headwinds in this market due to activity in the Eurozone, with Cyprus being a larger problem than a lot of people would have thought it would be. For the most part, I think what shocked market participants was the reaction by the ECB. It was well known that Cyprus took a hit, at least the two of its largest banks took a hit when Greece was rescued, I'm using air quotes right now, when Greece was bailed out several quarters ago. And Cyprus banks took a haircut. It was only a matter of time before they ran out of capital. They were strongly hurt by that haircut, and now they're feeling the pain. The ham-fisted reaction to this problem was, I think, a bigger crisis than Cyprus itself. And I think people were losing faith, just another piece at a time, in the Eurozone as a concept. So I think that hurt international income funds, particularly because they own so much European debt. So if we take a look at the results of, say, the 10-year U.S. Treasury versus a similar index of sovereign debt from outside the U.S., they trended together pretty tightly. Again, once we had problems with Cyprus start to take grab headlines, then the U.S. outperformed at that point, and the sovereign debt market was largely down for the entire quarter, although not as bad as you might think. They managed to claw back some returns through March. Again, March was a decent time to be in bonds anyway, so they ended up being down. I think the index was down just about 2.5% for the quarter. Could have been a little worse. Final group to take a look at is municipal debt funds. Here we saw that high yield outperformed over 1% for the quarter. General Muni Debt, which is a very large category, it was up very slightly for the quarter. So here's what underpinned that market. If we put the bond buyer general obligation index of 20 municipal bonds, that's the blue line right there. This is over the past 5 quarters, and the blue area to the right is the first quarter of 2013. Yields have come up strongly in the muni market, and this was to be expected. We talked about this at the end of last quarter, that munis were starting to find themselves in unusual territory where their yields were so very, very low. A bit of sticker shock on the part of investors. Once we had the fiscal cliff negotiations, once that can was kicked down the road and it was determined that at this time municipal debt, the tax exemption status of it would not be touched, we started to see munis start to rebound a little bit. However, yields also creeped up, mostly due to the Treasury market. I was not terribly concerned about the bankruptcy of Stockton. The last several municipal bankruptcies have all been foreseen well in advance, so that's not shocking to anyone. We see at the end of as the quarter closed out, that once it had, yields on the index peaked at around 4%. There was some consolidation right there. I still think that there's some support in Treasury or in the muni market, and we'll talk about that in the outlook. At the same time, the 20-year Treasury market was really starting to come back at the end of the quarter, which was unlike the muni market. So that it's interesting to me that munis are becoming a bit less coupled with Treasuries right now. This was something I probably should have put in a little earlier, talking about the international market. This is the problem with Europe right now. Their GDP figures are trending lower and lower with each passing quarter, and it doesn't look like Q1 2013 is going to pick up anytime soon. So here again we see why there are so many concerns with Europe. They're mired in recession right now. When Ireland has the better manufacturing numbers than Germany, that is cause for concern on the continent, and it does not appear that this issue that they have, not only their banks but the overall economy itself, they're so mixed and tightly woven together, you can't fix one without the other, and that takes a lot of time and a lot of money. So here we get to my outlook. I didn't spend enough time on this, but the loan market is on fire. Matt will plunge into the flows data on this to give you some context as to how strongly the loan market is looking these days. I think for the remainder of the year it's going to be tough for govies and treasuries. They're certainly under pressure. They don't have a whole lot of room to grow due to activities at the Fed. They're kind of keeping buyers out of the market because they are the main buyer right now. Saw a statistic the other day that if the 10-year Treasury yield, let's say a whole bunch of buyers enter the market, and if it dropped to 1%, that would still create a 1-year return of just 8, maybe 8.3%. So even a miraculous buying opportunity in treasuries is still not going to create strong total returns for investors. So that's keeping a lot of people out of the treasury market. Risk-on trading is obviously the reason why people are not searching for treasuries right now. If the saber rattling in Korea is resolved, we're really going to see the risk-on come into the fore, I believe. And I also find munis still attractive, even though we saw yields up at that 4% level, at least on a 20-year bond. That's looking a whole lot better than treasuries. So again, with people staying out of treasuries, still looking for munis, we did see, as a result of some of the fiscal cliff negotiations, that the top tax rate did go up, and that's supportive of munis. I think we'll have to wait and see what happens to the tax-exempt status of it. I think it will remain. I don't think ultimately that Congress is going to touch that. So that will wrap up the fixed income review and outlook for me. Thanks.